This is Fannie Mae. Now, we don't cover Fannie Mae's economic and multifamily market commentary every month, but we've discussed it enough for me to know that they take a little bit more of a pessimistic view than others. So I was a little bit surprised to find that their typical glass half empty predictions, maybe, I don't know, they lacked a certain kind of hopelessness, Addison. Maybe it's because I've gotten so used to their negativity that, I don't know, I could see some rays of light poking through, the cumulonimbus, the thunderclouds. I could see the light streaming through, metaphorically. Mm-hmm. So the haziness is forest fires. I'm not talking about that anymore. Now, storm clouds of Fannie Mae pessimism. A little bit of silver lining. Fannie Mae hasn't dropped their expectations of recession, and really their account of the multifamily market is governed by this expectation of a downturn. So their predictions for apartment rents and vacancies are largely a function of these economic projections as well. Still, average rent growth of 1.5 to 2% by year end, which is moderate but not dismal. That is according to Fannie Mae's projections, and it is lower than normal, but it's not as bad. Actually, they kind of patted themselves on the back because they were saying, well, CoStar actually has rent growth projections even lower. So I think they know a little bit that they're gloomy. Even so,
the owner of apartments.com is, if they went that route.
Yeah.
They're even worse.
Yeah. Exactly. So alongside this moderating rent growth, Fannie Mae cites CBRE projections of subdued but still positive NOI growth for property values. We're seeing them go down, maybe 10% or more. Now we can go and see the actual chart here.
I understand the need to have large scale research and large scale evidence, so you don't have a lot of what I do, which is just speculate. But
raw speculation.
What's pretty gloomy about this is hearing large places like CBRE or whatever saying values are still going down, or we're seeing some, we still think that NOI growth is going to be less than what we've seen in previous years. I don't really see those attitudes in OMs that I get sent.
That's a really good point. And this is why sometimes this is valuable. A take like this from Fannie Mae is valuable because, if their job is to paint a rosy, but you kind of expect that, right?
Yeah.
You expect that they're going to, that when someone approaches you with a deal, they're going to give their, the most optimistic, reasonable projection of what's going to happen. Now, Fannie Mae is a little bit more realistic, pessimistic, however you look at it. But I think it's incredibly valuable to have this idea pop in your head so that you don't get blindsided, and so that you're able to figure out, okay, which ways are they on the right track about, and maybe there's other ways that they're that they're a little bit too bleak. But either way, they see now they're using MSCI numbers here. Property values down by 10%. Now this is for March of 2023, but I think that they could be down even more now, and maybe down even further by the end of the year. Mm-hmm. Now, when it comes to cap rates, I think it's a little more interesting, actually. So they say that for cap rates, we're seeing them go up. Now, this is a chart of cap rates where they compare the base projection of CB. Now, they're using CBRE. They're comparing the base projection to a downside and severe downside. The base projection of CBRE is that cap rates land by the end of 2023, cap rates land at 5.3%. Now, that's up a little bit from now, especially up from the low point of 3.7 in late 2021, and really kind of the average cap rate. I mean, I'm trying to look at the pre-pandemic. It seemed about 4.5 was about the midpoint. If we're trying to average out between the Great Recession and the beginning of the pandemic, I'd say about 4.5 looks like. But
it looks like what they're okay. Never mind. I was looking at what they had the downside at thinking that it was more the base case, got the colors mixed up. But now initially I was intrigued by the fact that their downside is, hey, this could be what it was during the financial crisis or just that some of the years following.
So their downside actually so the downside CBRE projection is the one that Fannie Mae is hanging their hat on. They think that's the most likely. So this downside would mean cap rates go up to 5.7 by late 2023, early 2024, before kind of settling down to, what do they say, 5% by the end of 2024. So still not getting back to, the 4.5 range. Now, I'm just pulling that out because it looked about, at a rough average of the pre-pandemic, post, great financial crisis average, but still, they are likely to remain elevated through the end of the year, very likely to remain elevated, and through 2024. I'm going to be very interested in how quickly, if the Fed does pivot, how quickly they'll pivot. I have seen, I've heard stories of, people talking about that. Well, there have been rate cuts that have happened within a 6-month time span. There are other rate cuts that have happened at a little bit longer time span. If the run up is the same amount of time as a run down, then it's not going to happen, and it's not going to be a snap of the fingers kind of thing. So it's believable because they're already this high. It's going to take a while for them to come down. So that would seemingly keep cap rates a little bit more elevated.
Allow me to put my tin hat on here for a second.
I'm going to say it's driven by politics. Don't say it's driven by politics.
In 2024, yeah, I think it will be. Now, what I will say about this is, in the same way that I don't think Jerome Powell really wants to do anything drastic, I don't think he wants to raise rates, unless really has to. I think the flip side is going to be true as well. Headed into a presidential election year, I don't think he's going to lower rates unless it is like abundantly clear that he has to, or that if he doesn't, he's going to hold the economy back. Now, that in and of itself doesn't sound like too much of a going out on a limb, but I get the sense that going into 2024,
he doesn't want to bring about inflation.
I don't think the Fed wants to be seen as either tipping the scales for Biden's reelection or preventing it.
Oh, so it's not. So it is in a way political because he will so actively avoid the idea that he's politically motivated that it will end up motivating him anyways.
Again, that's good.
I like that. So it's not really, but it is kind of good.
I think that's another major piece of speculation, but I can't imagine, given what appears to be Jerome Powell's demeanor, that he is going to want to be someone that wants to be in the limelight, and that when the dust settles in 2024, no matter how that election goes, that I don't think he really wants the Fed to be kind of where people point in terms of what decided it or what didn't.
Yeah. And, even in the increase in interest rates, they were telling us where they were going. And we knew, like we explained, before, they don't want to bring about any surprises either. And any kind of motion that they'll take either way. You're going to see it in comments. You're going to see, an individual member maybe say something, and then maybe you'll read about it in the minutes of a meeting. And then, they'll slowly build up and then they'll act. But we're ways off of that. We're still in this high rate environment.
On the flip side, though, I wouldn't be surprised if, hearing the reports of Trump pressuring Powell for certain things over the course of his presidency, I wouldn't be surprised if Jerome Powell's sitting there thinking, who do I want to
go? Yeah. That's good. That's good. I like that. Oh, man. And you know what? And a coworker was saying, how about they just don't do anything? How about we just lock them up till the end of the year, keep rates at the same, and then, give them a break.
Is that coworker Addison?
No, it's not Addison, but is that what you said?
I mean, I don't know in terms of I guess where they need to be now, but no, I do think you and I are on the same footing that they could have probably paused the last 2 or 3 meetings and been fine.
Yeah.
But
yeah. There is this, I think now we're in the, quarter point raises are, they are material but I think we're dealing with a very shaky psychology. And they're erring on the side of inflation, which again, I think speaks to their assumption of a healthy economy, I think. Or at the very least one where they got tools they can lower it at least, right?